So we're going to go ahead and get started with the annual client webinar for 2026, and here we go. First and foremost, and you're not seeing anything weird there. That is a slide for the United States Postal Service. But the first thing that I want everyone to take away from this presentation, and keep your eyes and ears open on this one because there's a big change here. There are some changes with the U.S. Postal Service that will affect how you, if you're going to be mailing tax returns or forms or payments to the IRS or to any state tax authorities here in the U.S., and you're doing it through the U.S. Postal Service, there are some things to be aware of. So, as a little context or background, where we have the intersection of the U.S. Postal Service and the Internal Revenue Code, that comes into Internal Revenue Code 7502. That's where the two shall meet, if we will. And basically, what 7502 details is what does a postmark mean when you're mailing something in to the IRS? Well, the postmark means the date that the IRS is recording as being received by the IRS. So even though it's not yet been received by the IRS, it's just been postmarked by the U.S. Postal Service. The IRS will treat that as the day received by them. Okay, so very, very important rules that we have here. There's a change, though, in the way that the Postal Service is doing their process on this. So in the old process, you would go to the post office, you would take in your mailing or your check or whatever it is you're sending in, you would give it to the clerk, and the clerk would put the postmark on it, and then you could be assured that, hey, it's postmarked. If it's April 14th, I know that I filed it timely. I don't have any issues with getting this in. The IRS isn't going to mark it as late. I'm good to go. Okay. There's a new process that's already begun. It started on January 1st, 2026. You can look it up. I bet you didn't think when you woke up this morning, it wasn't on your bingo card that I was going to give you a post office code section, but it's new section 608.11. It's called Delivering for America. And what happens is that the Postal Service no longer will automatically postmark a letter or a payment or anything when you go up to the counter and you give it to them. Okay. What's going to happen is they're going to take that mailing and they're going to put it in the box. And then at some point, there's going to be an automated sorting machine that will then postmark that envelope or that document. So that could occur a day later, 2 days later, a week later, you don't really know. Okay. So if you're going to mail something into the IRS or to the states and you think it's timely and you do this process, so for example, I go on April 14th, and if the automated sorting machine doesn't stamp it till April 20th, then it's going to be deemed to be late by the IRS and you're going to get penalties associated with not getting in the return timely. So very, very important. Understand that there is a new postmark process with the U.S. Postal Service. So the next question in your head is, well, what are my options? Well, you can use registered mail, you can use certified mail, you can use private delivery service, you can use first class mail. These are all very expensive to do, but hey, if you think you need to cover yourself, then go ahead and do one of these. You can also do this technique called a PVI label. You have to request that when you go up. So you give the letter and you say, hey, before you do anything, I need a PVI label on that. And supposedly the PVI label will work as the postmark. I'm not gonna, so if you were to ask me, like, Mish, what is your 2 cents? Which one of these would you do? I'm a very old-fashioned kind of guy. I still like to write letters to my grandparents. I would do USPS certified mail return receipt. I'm a big fan of the green sticker and the green card. In fact, I've got a stack over here in my office. I mail, anything into the IRS, which I still like to do, for estimated tax payments or whatnot. I like to do that certified mail return receipt. And just, my 2 cents on this is take your time. There's a lot to fill out on the certified mail return receipt. Do it in the comfort of your house, get everything kind of lined up and then go in the post office and get it sent off, with that process. I find that if you go in there and with blank forms or you go in there and you try to, do it while you're in the line, if it's not complete when you get up to the counter, they'll make you go to the back of the line, complete it, and then come back up again. And that's just frustrating to sit there and have to wait that entire time, and no one really wants to do that. So keep in mind this new technique with the post office if you're going to be mailing stuff in, and my recommendation is to use certified mail return receipt. Okay, next big thing to be aware of. We had an executive order last year that basically said that from September 30th, 2025, so last year, the IRS will no longer be issuing paper checks. So if you file a tax return and you don't put your direct deposit information in there, and you do a refund, you used to get a paper check from the IRS. That will no longer be occurring. there's this fact sheet 2026-02, and I've linked, there's annotations for all these things that I've linked into the PDF so that you can go look at it if you want to. But it's a really well-written fact sheet. It's divided into 5 topic sections, A through E. And basically, for people that don't have bank accounts, they have this new thing called mycreditunion.gov where you can get a bank account, I think for free. So, for low income taxpayers, for example, that maybe don't use bank accounts or can't get a bank account, this may be a resource for them to be able to get their direct deposits. So that's one takeaway from that. The other takeaway is that if you file the return on accident, maybe you didn't realize that you had to put your direct deposit info. So for those that maybe already filed back in January, or maybe you submitted something, after September 30th last year and you didn't realize this change, what you will get, we don't yet have a copy of what this will look like, but there's a special notice that will be sent out called a CP53E notice that'll be at the top right-hand corner. And it'll tell you, hey, we can't send you your refund until you give us your direct deposit info. Please do so. And then you'll have to complete that. I will note question 6 here, which is that they will contact you to your last known address. And a word to the wise, this is a sub issue, but if you've moved or you changed your address, not only should you change your address with the Postal Service, but you should also change it with the IRS, which should then change it with the rest of the federal government. There's a special form that you can complete, and I think you can also do that on your IRS online account as well, which I'll talk more about here at the end of the presentation. So keep that in mind. Okay. One thing that I did not realize, though, is that at some point the IRS will no longer be taking payments through check or money order. So for now, you're fine. If you're going to be mailing in a balance due or an estimated tax payment for 2026, you're okay. But very soon, the IRS is going to cut off the ability for people to do that, and you're going to have to make your estimated payments online, again, through your IRS online account or through FTEPs. I think maybe even FTEPs may be going the way of the dinosaur as well too. So yeah, if you haven't got the theme here, the IRS online account is going to be the way forward. So keep that in mind. Now there are other payment options available. The IRS in Q3 here gives you several different options here, but those again are going to be going electronic. Unfortunately, for our folks that live outside of the United States, our international taxpayers, there are no changes there with direct deposit or direct payments from foreign bank accounts. I was super hopeful that they would do this. I don't see why they can't do it. You can get your Social Security payments living offshore through direct deposit to a foreign bank account. So the ability to do it through the Treasury Department is there. Why the IRS does not have the ability is beyond me. I do not have an answer for you. I apologize for that. But I'm very hopeful that they'll get tuned in attunement with or in alignment with the way that Social Security does it, and then very soon folks will be able to make payments and get deposits from their foreign bank accounts. Okay, the next topic I have for you on the docket is Trump accounts. This recently, I think this past week, it made a little bit of news about people that have already signed up for this. If you go to, I think it's trumpaccounts.gov, this page will pop up. Basically, a Trump account is an IRA, individual retirement account for a child or a minor child. You can't open these yet. They're not available yet. You can't put any money into them yet. Apparently, there's going to be a big marketing push for the 4th of July celebration. And then on July 5th, you can, I guess, go to your local bank and start making contributions to those. But in order to do that, you have to get the account opened for your child. Okay. And the way that you do that is you complete IRS Form 4547. That should go with your tax return for 2025. Just because you open the account doesn't mean you have to put anything into it. So this is just giving you the ability to have the account opened. If for some reason you file the 2025 tax return and you don't include the form, no harm, no foul. You can send the form separately. Yeah, I think you can even go online and complete the form. It's not a very difficult form to complete. Something that you can do at any point in time that you want to. For children that have U.S. Social Security numbers that were born between 2025 and 2028, the federal government, once the account is open, will deposit $1,000 into the account. And then from that point forward, parents, grandparents, anyone can put $5,000 into the account. Half of that can come from an employer if the employer is willing to do it. Nothing says the employer has to do it, but if the employer offers it, then they can put it in there. There is an IRS notice that's detailing that, and there's been a lot of urging, if you will, from folks in the federal government to urge employers to make that available to employees. Okay, we have a problem though. Houston, we have a problem. The One Big Beautiful Bill Act, which I call OB3, and we've got a podcast and all the changes to OB3. I'm not going to go through a bunch of those today. So if you want to listen to that, let me know. I can send you the link for it. You can go find it on Apple or Spotify. But the problem when you write a tax bill and you shortchange the timeline on it, and so OB3 was written in 45 days, is that you're going to end up with problems. You're going to end up with errors. And we have our first identified error, which is that the Trump account language is missing a key critical component of language that makes any contribution to a Trump account part of the annual gift tax exclusion, meaning that if you make a contribution to a Trump account, even if it's only $4,000, $5,000, that does not qualify for the annual gift tax exclusion of 19,000, meaning that you will have to file the Form 709. So even if I just put $25 into a Trump account for my child, I still have to file the Form 709 to report that as a gift. It does not get the annual gift tax exclusion. Unfortunately, this error cannot be fixed by the IRS or the Treasury Department, meaning that Congress is going to have to write a law. They're going to have to do their job. Um, and just so you guys understand, what should they have done? It's real simple. This is from the 529 plan language. All they had to do was copy and paste to AI, this little sentence right here, to AI, and that would have done the trick. But because that's not in there, it doesn't qualify for the annual gift tax exclusion. ActTech, which by the way is a fantastic organization, they also have a great tax podcast, wrote a scathing letter to the IRS, kind of detailing all of this. I've kind of highlighted the areas that it talks about. But again, if you make a contribution to a Trump account, then that is going to have to trigger filing of a gift tax return. So be aware. However, potentially we could have some tax legislation here in 2026 before we get to July 5th that could fix that. We'll talk about that here in a minute. Okay, next topic, digital assets or cryptocurrency. So we got some big changes on the cryptocurrency front. First off, there's going to be a brand new form. So if you have crypto with Coinbase or a registered provider of crypto, a broker, if you will, they're going to be giving you this new form 1099-DA coming soon to a theater near you, probably before the end of the month. If you have crypto, you'll get this. One thing you'll note, though, is that the basis amounts are not going to be reported on here. You won't see that for 2025. You'll see that for 2026, but you will not see that for 2025. The reason is because the taxpayer has to self-report their basis. And we've got a change in how basis is reported for cryptocurrency assets. So prior to 2025, you had two different ways you could do your basis. You could do a technique called universal pooling, or you could do a technique called specific identification. For 2025 and every year moving forward, you can only use specific identification. And if you haven't been using that technique and you've been using universal pooling, you will have to do what's called transitional relief, meaning you'll have to report to the IRS how you're transitioning from universal pooling to specific identification. The details for how you do that reporting is in Notice 2025-07. Here's a snip of that. My observation here is that if you are going to be doing that transition reporting, and this is a big, big deal in my opinion. This is kind of a once in a lifetime opportunity for taxpayers to really tell the IRS what their basis is. Once it's in there, and that's what it will be for all years moving forward. So this is it. If you're gonna any adjustments to basis or anything you want to do for basis, now is your time. Okay. So I would say you need to use a tax professional to do this and help you with this if you have this problem. I will also note that Form 8949 has expanded. It's gotten bigger. There's more stuff to it. You see here, I've highlighted in yellow all the different additions for the cryptocurrency reporting. It now has its own schedules that are attached to the Form 8949 for reporting. So it's getting more granular. It's getting more detailed. There is more reporting that is being required for cryptocurrency transactions. The last thing for crypto or digital assets that I want to remind everybody is that if you have crypto located in a foreign wallet or on a computer with a foreign server, that is not a foreign financial account for purposes of the FBAR. FinCEN's made it clear that at this point in time, they don't want you to report that on the FBAR, so no need to do that. You still, though, my recommendation, report that on the Form 8938. And we believe that to be a specified foreign financial asset. The IRS has not said no. Silence is deafening. So I would tell you, if you have it, report it on the 8938. Not, and again, that's not US crypto. So Coinbase crypto, crypto in your Fidelity account, not required, but crypto outside the US, certainly something to think about. Okay, foreign financial asset reporting. And I think I talked about this case last year, the Sadem case, but I want to reiterate to everybody that there are some new standards for what the IRS is going to be using to determine to push a case against a taxpayer if they fail to file the FBAR or fail to do it correctly for what we call willful blindness or recklessness. And that is basically putting the burden directly on the taxpayer in regards to the actions they took to determine if they had a filing requirement for an asset or not. So, just as a reminder, willful blindness means that there's a high probability that you knew you were supposed to report something, but you deliberately avoided doing so, kind of like that ostrich, right? The ostrich puts their head in the sand. They don't want to see what's happening. Same thing here. Don't be an ostrich. Recklessness, again, will get you to be willfulness, will get you to be willful versus non-willful, which can mean hundreds of thousands of dollars of penalties. Is basically you knew that you should have done something, you should have checked out, a reasonable person would have checked it out, and you could have confirmed it, meaning you could have reached out and asked somebody, a qualified CPA or an attorney, and you chose not to do it. Okay. So the facts of what you did and how you did it are going to be very important if you get caught with that issue. I will note that there is a follow-up to the Sadem case. The Sadem case, he did try to argue that the FBAR penalties were a violation of the Eighth Amendment, excessive fines and clauses. The court here, the 11th Circuit, said, nope, we don't agree with that. So there is kind of a split happening here about the Eighth Amendment challenge to FBAR penalties. And likely this could go before the Supreme Court if Sadem really pushes it. We have the Segu case. That's the next one up. I love this case because this is so interesting on so many different levels. But the way that Segu actually got out of the FBAR penalties was that Segu made a challenge. She made a challenge under the Seventh Amendment. What is the Seventh Amendment? It's right to a jury trial, okay, which takes us right back to Sadem. Sadem had a jury trial, and the jury was given instructions about willfulness here. That needs to happen. If you're not getting a jury trial, then your FBAR penalties are probably not going to stick. Jury trials are iffy. Okay, so that's a hazard of litigation that the IRS now has to factor in if they're going to push FBAR penalties. So the moral of the story here is that if you have FBAR penalties being assessed by the IRS and you want to try to negotiate a deal with them, I bring up hazards of litigation and talk about, hey, do you really think you can win this one in front of a jury? Because guess what? Segu got it dismissed under the Seventh Amendment. Okay, I'm not going to go through these cases. I'm just going to put these are cases that kind of came out and so these cases highlight the fact that there are still a lot of movements going on for Panamanian companies, insurance wrappers, folks using false names and sham structures. The Leeds case is a super interesting case, the one here on the right of the slide. CIA agent that had foreign bank accounts used while in the employment of the CIA, didn't report them. Guess what? The IRS got them. So that's an interesting takeaway there. We've got the Noel case, which is this individual tried to do the offshore voluntary disclosure program, got all the way through the program, was assessed the penalty, never paid it, and because of that went into audit. We've got the Kerr case, which goes back to talking about Schedule B Part 3 and the questions that you're answering there. Again, very, very important about how you answer those questions. We've got the Baraboo case, which is super interesting because it really goes into Australia. It's the first one we've really seen that's brought up a lot of the Australian bank accounts. There's 20 bank accounts in Australia that were not reported correctly. That one highlights that there's a lot of information sharing between the IRS and the ATO. So if you've got Australian foreign financial assets, that's a big hot topic these days. The Kurataki case, again, super interesting case. This one was interesting because what happened is that they were trying to give Kurataki information in Japanese. So they were doing conversion from English to Japanese, and the translated versions were going back and forth, Japanese to English, English to Japanese. And Kurataki did not understand some of the questions that were being asked to him. And he said, hey, when the question was translated over, the translation didn't work very well. And I didn't really understand that that was the question that was being asked. The point is that if you are translating documents for your client or you're working with a professional that's translating documents for you, make sure to read that thoroughly and make sure those translations are done correctly. Okay, very, very, very important. Don't just rely on AI functions to get that done. We have the Jenner case, which the long and short of that is that if you do get an FBAR penalty, you cannot challenge that under a collection due process hearing because guess what? FBARs and FBAR penalties are not part of the Internal Revenue Code. The IRS just enforces the penalties. They don't have the authority to that's not where the authority comes from. So because the authority is not with the IRS, it's under Title 32 of the Bank Secrecy Act, you cannot do a collection due process case on that one. And then the last one I think I've got here before we get to the states is the Veerswamy case. And I bring this one up. This was a recent case. This one, the IRS really spent a lot of time, and the court spent a lot of time talking about, and it's right there in the middle, the education of the taxpayer, which is something that I've always said is very, very important. It's one of the things that the IRS is going to ask. What are you educated in? What do you have your degrees in? What type, what do you specialize in? Should you have known to do some of the reporting? So very, very important that that could play a factor in any kind of FBAR litigation that could be posed against a taxpayer. Okay, states. We've got another big bombshell here that I want to go over with everybody. So again, the One Big Beautiful Bill Act, I call it OB3. Again, I love Star Wars, so I like OB3. I like the way it sounds. But states do not like OB3. Okay. What happens is that the OB3 is basically lowering the state revenue, and that's not what states are trying to do. Most states are trying to raise their revenue. And in fact, states are kind of looking at their lips and chomping at the bit to raise taxes once they saw the fact that the state and local income tax deduction went from 10,000 to 40,000. States were saying, "Hey, we can add some estate tax increases because folks are going to get those deductions at the federal level anyway. Maybe not." So you have a lot of states on the left-hand side that are decoupling from selective provisions, meaning they're somewhat conforming, somewhat not conforming. You have the states on the right-hand side that have said, nope, we want nothing to do with OB3. And then you have states that are partially thinking about conforming. So Massachusetts and then Maine just announced today that they were thinking about that as well. Okay, why do I bring all this up? Because the District of Columbia very quickly said we don't want anything to do with OB3. We're not conforming to the deduction for tips, overtime, auto loan interest, or the additional standard deduction for senior citizens. I guess that made some folks in Congress mad. And we've got this result here, and I'll get to it here in a sec about Congress. But if you go to the District of Columbia website and you look at the 2025 tax return page, at the top it says, "Hey, that the forms will be delayed. Be aware." But here's why they're kind of putting that up there. This was passed on February 4th, 2026. The House said, "We do not like the fact that the District of Columbia has decoupled from OB3. They need to conform." And they can tell them to do that because the district is not a state. Okay. There's similarly a bill in the Senate. Here it is. It has not yet been looked at. It has not yet been taken up. But if this is passed and the president signs it, we got bad news bears because this is a letter written by the District of Columbia to the Senate saying, please don't do that because guess what? The District of Columbia would have to cancel the filing season, meaning you would not be able to file your 2025 tax return until later this year. That whole process would come to a screeching halt, and it will take the District of Columbia months to go back and update their tax forms to incorporate all the changes. This is not just individual, this is business. There's a lot of things that would have to be redone. The amount of changes would be significant. And the District of Columbia is saying this will not only change the tax filing season, it changes how we raise revenue. There's a huge financial impact. It's a delay that would affect the federal return probably for these taxpayers as well. It's a big, big deal. I have no crystal ball. I have no idea how this will play out. It seemed to move very fast at the beginning of the month, and then it's kind of come to a screeching halt. So last week it was the talk of the town, and then I have no idea. Super Bowl happened, and who knows where we're at now, if it will be picked up again or not. But we're going to keep a close eye on it, and as things come out, we'll certainly put out any alerts on what's happening here. But this is a big, big issue for anyone that's filed in the District of Columbia. I do see some folks that are raising hands, but if you have a question, make sure to put that into the Q&A, please. That's where we want to put that at, and I will get to that here in a second. There's a question, though, that I'll answer right now. It says, what does decoupling mean for Maryland residents? There is no decoupling for Maryland, or maybe there is. I don't know. Let's see here. Is Maryland? Maybe you're right. Is Maryland on the list? No, Maryland's partially decoupling, and I don't think there's anything relevant for individuals for Maryland. But let's talk about Maryland here for a second. Maryland is got a brand new tax. They're raising their taxes. They've been doing it over the last couple of years, slowly creeping up. So Maryland's got a new 2% tax on net capital gains. And how does that look? So what happens is that you take your federal adjusted gross income, and if that is $350,000 or higher, and part of that has any capital gains in it, then you're going to get an extra 2% tax on those net capital gains. I will note that this new tax, which does apply to 2025, so it's been in effect, was in effect all last year, and in effect this year, that does not apply to the sale of real property in the state of Maryland, and it does not apply to retirement distributions. Those aren't capital gains anyway, but I think Maryland just wanted to clarify that wouldn't apply there. Okay. Maryland also has apparently there's a lot of taxpayers in Maryland, and I'm not sure why this is the case, why this is happening, but apparently a lot of taxpayers in Maryland are reporting scams. They're being scammed by people saying impersonating Maryland, Maryland tax people, or scams trying to get payments for Maryland tax due that aren't real. Maryland, it's such a big issue that Maryland's kind of put out a little guidance here that says, look, if you think you're a victim of a scam, or you think your identity's been stolen, or you think someone is doing something that is illicit, you can call us, you can email us, you can schedule a meeting in person, you can do a virtual meeting. We want to hear about it. We want to know about it. We want to combat it. I haven't seen Virginia or DC really put anything out about scams in either of those places. So I'm not certain if anything's happening to those taxpayers, but it appears Maryland's having some issues there. So be aware if you think you're a victim of a scam or know if someone is, make sure to share some information to help them out. Okay, there is one last bite at the apple before we get to the midterm elections, meaning there could be one more tax bill that comes into play. We've identified that the Trump accounts need to have some legislative updates. This is kind of a laundry list of all the different things that have been put out there that are trying to make their way into a potential new tax bill. So we had the One Big Beautiful Bill Act. There's After that was passed, they were talking about, hey, we're going to get a second one going as soon as possible. In fact, some folks were already calling it too big, too beautiful, too B squared, whatever. I don't know if that's going to end up being the name or not. Certainly, someone has a sense of humor about the whole thing, but these are the things that you may see play into the new tax bill. So, if you watch the Super Bowl like I did this past Sunday, I think what was it? Every third commercial was about gambling. So apparently we like to gamble here in the United States. And none of the gambling bros, they were all unhappy about the fact that the gambling deduction was limited to 90% under OB3. That was a revenue raiser. It had to come in to raise some revenue to offset some of the things that they were trying to cut. So people want that to be put back in under this new tax bill. Will that come back in? I do not know, but that's definitely proposals are floating around both in the House and the Senate. For the first time, we have a change to U.S. tax resident and non-residency status. So I think most of everyone on the call knows that tax residents have generally always been citizens, green card holders, and individuals satisfying the substantial presence test. Well, we've got a new entrant to the game, gold card holders. That's right. And for non-residents, we have a new type of non-resident, platinum card holders. Yes, that's right. You heard it here. The United States is becoming American Express. So for those of you that don't know, the gold card is a thing. It was going to be the tax rules for the gold card were going to be in the One Big Beautiful Bill Act. There was in this initial proposal in the Senate for their version of it, they had this section 7205. It was there, and then at the very end, they pulled it out. They decided not to put it back in there. I don't know why. It would have been apparently it would have been a huge revenue raiser, to put in there, but they pulled it back out. They decided not to pull the trigger. If you went to trumpcard.gov for the longest time, this is what you saw. And then on September 19th, it magically changed overnight. And then this is what you saw. And it's all because there was this executive order that was issued on September 19th that said, let there be the gold card. And so when you went to the website, then you saw here, there's the gold card and there's the platinum card. The gold card basically is a green card on steroids. So basically, you have a bunch of people that have applied for a green card. They're all waiting in the queue. And then the gold card says, look, if you pay $1 million, which by the way, your $1 million serves as evidence of your exceptional business ability and your national benefit to the United States government. That's what your $1 million pays for. We will move you from the back of the line for the green card to the very front of the line, and you'll get your green card before everybody else. And maybe your green card will have gold on it. I don't know. If you are a corporation applying for an individual, then it's $2 million. Okay. The Platinum card, which is not yet available yet, you can't register for that one. You can reserve a spot for it. Again, they have to have tax rules to get this thing off the ground. Basically, instead of 1 million or 2 million, you pay $5 million. You can be in the United States each calendar year for up to 270 days, no longer than 270. You are only subject to tax on U.S. source income. You are not subject to tax on worldwide income. You don't have to do worldwide informational reporting. You're not subject to U.S. gift and estate tax. And so just every single year, 270 days, U.S. source income, rinse and repeat, rinse and repeat, enter and leave, enter and leave. Okay. But in order to get those in, you do have to update Internal Revenue Code 7701, and here's the section where you would make your changes. So in 7701A, you would have to enter in a fourth option for the gold card, and in 7701B down here at the bottom, you'd have to enter in rules for the platinum card for non-residents. And then Bob's your uncle. Everyone gets access to the Centurion Lounge, and we all move on with life. If you want to learn more about the green card, gold card, I did a podcast with Jason Levy. He's formerly of DHS. The guy knows the most about immigration law that I've ever seen in my life. I remember being in law school and I took a look at the immigration law textbook, took one look at it, said, nope, not doing that. But he knows so much. He's got all the case law, like out at the back of his head. Fantastic resource there. He's worked on a lot of stuff prior to leaving the U.S. government. He wasn't able to give me all the insight on the things he was working on before he left, but really good conversation we had about it. There is this act has been around for a very long time. It's been proposed and reproposed. This is the Residence-Based Taxation for Americans Abroad Act. Super interesting. I would say, prior to 2025, I gave it a 5% chance of passing, but now I give it more like a 25, 30% chance. And basically what happens is that this applies to only US citizens. You would make an election on your US tax return. This is assuming you live outside the US. So you make an election on your US tax return. You have to go through the US exit tax. The difference, though, with this bill is that the US exit tax, the net worth test, is not 2 million, rather it's 15 million. So they're going to give you the entire unified credit for gift and estate tax. And you go through that. And as long as you complete that process, you are considered a non-resident US citizen, and you can get a certificate from the Treasury Department saying that. And then you're no longer subject to worldwide taxation, and you're no longer subject to worldwide information reporting. You do have to report and pay tax on any U.S. source income. Outside of that, though, you're free and clear. You can go buy PFIX and get a foreign trust and a foreign corp and a super fund and whatever else you want. And you'll get your little special certificate that you can take to foreign financial institutions and say, hey, you can't deny me a bank account anymore. You can get whatever product you want anywhere in the world, according to this proposal. Super interesting, been around for a very, very long time, but seems to be maybe gaining a little bit more steam now than ever before. Okay, for the G4s that are watching this, there is always problems with FIRPTA. FIRPTA is the withholding tax on the sale of U.S. real estate. The 8288B, which is the request for reduced FIRPTA withholding, at the Wolf Group, we haven't done that for years because it simply doesn't work. The IRS takes them forever to look at those applications. It's a lot faster just to allow the withholding to occur and then ask for your money back when you file the return in the following year, which you have to do anyway. However, the IRS knows this is a big issue with the 8288B, and there's been proposals to say, look, if you submit an 8288B for reduced withholding, and the IRS, we will give the IRS a maximum amount of 180 days. And on the 181st day, if you don't hear back from them, you can assume the IRS has accepted your application and you can get your money back immediately from the escrow or title company at that point in time. Okay, so that interesting potential amendment to 1445, to Revenue Code 1445 for FIRPTA. I just did a podcast with David Roche of KVS Title, very good title company in the Virginia, Maryland, DC area. We talk about FIRPTA and kind of his thoughts on where we're at with FIRPTA here in 2026. So if you want to learn more about that, I suggest you log in and check out the podcast. There are a lot of bills that are aimed at propping up the housing market here in the US. So we have bills that are aiming to eliminate the capital gains tax on the sale of a primary residence that are potentially, if that's not going to happen, change the 121 exclusion amount from 250 and 500 for single and married to 500 and a million for single or married. We have, there's a bill that it's not on here that would give another first-time home buyer tax credit, which I think is $50,000, but that's payable over a 5-year period. So each year that, so you buy the home in year one, you get a $10,000 credit, and then each year thereafter you get $10,000 credits. Not that sounds pretty extreme to me, but hey, that's what the proposal says. We've got a lot of people in the digital asset space clamoring for crypto legislation. The White House put out a digital asset report back in July of last year, and in the table of contents, if you look at the very last section, they spend a good 15 or so pages talking about what they would like to see in crypto tax legislation. So you've got their position on it. You've got the testimony of Vice President of Coinbase, Lawrence Zlatkin. He went before Congress and testified on what Coinbase and other digital asset brokers would love to see in there. You've got the Digital Asset Parity Act by Max Miller. That's got some framework that's already been issued. He's kind of taking the lead on that. So, we may get some crypto tax legislation here in 2026 as well. NIL. So there is a proposal for those of you that are interested in, all these athletes doing the transfer portal in college and getting paid millions of dollars and what will happen to them. Well, they've kind of cut and paste some of the NIL trusts that are used in Europe. That's a common thing used for soccer players in Europe, soccer and rugby players, where their payments for their name, image, and likeness, that's how they get paid, go into certain trusts. Well, the same thing would happen here in the US under this legislation. And basically, they would put bumpers around how and when the student athlete could use the money. And most of it cannot be used until they actually graduate from college. So you got to graduate from college to get your cash. And then there's certain steps that can be taken after that. When President Trump was campaigning, on the right-hand side of the slide, one of his promises was that he would eliminate federal tax on compensation earned income by military members, not retirement income, but earned income. That was not part of OB3, so that one is still kind of floating around out there. You have this on the right-hand side of the slide, you have this bill that's aimed at taking away the ability of members of Congress to buy and sell stock while they're members of Congress. So no more insider trading for those folks. They now have websites that actually track members of Congress as they're buying and selling stocks so that you can see the insider trading that they're doing and maybe hop on the bandwagon. You've got a lot of proposals and changes for health savings accounts. Give them, higher contribution limits, more flexibility on what you can spend those on, perhaps even having the federal government make deposits for every taxpayer that has one of a small amount. You've got the freshman senator from Ohio making waves. He's got two very provocative tax bills that he's put out. So the first one is this outsourcing labor bill. So I'm going to use our good friends at KPMG as an example. KPMG is one of the big four accounting networks. It's no secret they have an entire outsourced labor pool in India and I think the Philippines. So for example, a lot of individual tax returns are not done by KPMG in the United States. They're farmed out to tax preparers that are foreign individuals in India and the Philippines. So for example, under this bill, KPMG would have to take the labor, the cost of their labor pool in India and the Philippines, multiply by 25%, and pay an excise tax to the federal government for that cost. And then on top of that, they would not be able to take a deduction on their corporate income for their foreign labor payroll as well. So it's a double whammy for any company that's using foreign labor under this bill. Secondarily, the freshman senator from Ohio, Mr. Moreno, has put out this Exclusive Citizenship Act of 2025, meaning that you cannot be a dual citizen with the US and any other foreign country. If this were to pass, you'd have 180 days to renounce your other citizenship, so your non-US citizenship. If you fail to do that, then you are deemed to have renounced your US citizenship and the US exit tax and the brand new Section 2801 tax, which we finally got regulations on last year, which is an inheritance tax for any US citizen or domiciliary heir. So that tax is pretty gnarly. Both of those would kick in immediately should that occur under this bill. So two very harsh acts. There's this Home Savings Act, which would allow for withdrawals from the 401k for down payments to purchase a home. The Barcode Act is actually something I think you may actually see come in, which is that every tax return would have a scannable barcode. So you could easily look that up or check into that, both on your IRS online account and through the IRS directly. They want to change the remittance transfer tax. So currently this is a thing. We do have it. It was under OB3. It only really applies to individuals that are sending cash or cash equivalents through, say, Western Union to someone living outside the United States. If you currently send it through a big bank, doesn't matter who you are, not a problem. But under this potential, this was the U.S. representative in Virginia, Mr. McGuire. did not like that outcome, wants to get that changed and increase the tax from 1% to 15%. And then the only exception would be for people that are US citizens or nationals. So if you're not a US citizen or a national, you would then have to pay pay the 15% regardless of where the money is coming from for any money transferred from inside the US to outside the US. Okay. Um, the Republican Study Committee, the RSC, which feeds directly into the tax writing committees, also put out what they want to see in the new tax legislation. This came out in mid-January. So they were also talking about eliminating the capital gains tax on the sale of a home, including the sale of rental homes. So they, kind of a two for one there. They want to establish or create a home savings account. Didn't really specify what that would mean. They want to increase the remittance transfer tax to 5%. And they want to increase the contribution limits to 401ks. So, for example, if you're married and you have one spouse that's working and one spouse that's not working, the contribution limit would double in that scenario because it would include the non-working spouse as well. They want to get rid of the federal estate tax. That's something that the Senate Majority Leader John Thune has wanted to do for a very, very long time. I think that's pandering kind of to his wants and needs. They want to create this residential emergency asset accumulation deferred tax yield account, which is basically if something happens to your home through some kind of disaster, that you'd be able to tap that account to help um, pay for that the potential issue. They want to, and I don't again, I don't know how you do this, but they want to end the incorporation of inflation when you sell a home. Somehow back that out of the capital gain. If you can't eliminate the capital gains tax altogether. The taxpayer advocate also has kind of gotten into the foray here and offered some changes that they would like to see in this new tax bill. So the taxpayer advocate thinks that filing the FBAR and the 8938 is very duplicative. I agree wholeheartedly. In fact, I despise having to file both for clients because you're reporting the same thing. It's kind of in a roundabout way going to the same place. And so this potentially you could see the relief from duplicative reporting. There's always been a contention here about international penalties need to be reviewed by a manager at the IRS and actually signed off. Normally, it hasn't been done that way, and so they would want to make that law that an actual person's got to sign off on a $10,000 penalty. I think that's just common sense. They want to clarify the what goes into establishing willfulness. Is it just answering the questions on Schedule B? Is there more to it? That's still kind of a gray area. Again, you're seeing a lot of court cases that we talked about at the beginning of the presentation related to that. I did put forth a proposal very, very long time ago. I think I wrote this back in 2019 about having an informational brand new schedule called Schedule IQ. You can read my blog post about it. I would get rid of Schedule B Part 3, and I'd have a very, very explicit write-up that I would give to all people filing tax returns that you would be required to read. Okay, and last but not least, normally when tax legislation is passed, there's a technical corrections bill that comes out afterwards to correct any errors. And so for the Tax Cuts and Jobs Act of 2018, which took 50 days to conceive and pass, there were 78 different errors on that bill. There's never been a technical corrections bill for that. That's a crying shame. I think any tax practitioner, doesn't matter what your political beliefs, would agree. There should be a technical corrections bill to get that thing taken care of. We've identified one error on OB3. That one took 45 days to pass. I guarantee there'll be many more. And I think there should be a technical corrections bill for OB3 as well. So I'd love to see, this is just me kind of opining for myself here. I'd love to see for both. Okay, IRS updates. This is a big one. I want everyone to kind of listen up here. AI, generative AI. I know people love it. I know people love asking Chat GPT. I'm watching people, reality shows I was watching Southern Charm the other day, and one of the character members was asking Chat GPT how to fry bacon, or should he break up with his girlfriend, or I'm just like, you're letting AI run your life. What's the deal here? But here we have AI. You have a taxpayer that filed a tax court case. They got an attorney to represent them. And the attorney did an AI search, didn't say generative AI, just said AI large language models, what they use to do the research. And the AI returned that there was 4 cases that could be used to argue that the IRS has to manually sign a notice of deficiency. And when the IRS went and checked the citations, they found out, lo and behold, 3 of those cases didn't even exist. The AI made the cases up. And AI does that. AI will quote unquote hallucinate answers if they can't find answers. Okay. I test AI out on a regular basis. I'll just put a question in to see what the response will be. And I'll tell you that in my world for the international tax, I would say more than 50% of the time the AI is wrong. And it will make up Internal Revenue Code provisions that don't exist, Treasury regulations that don't exist, whatever it can to make an answer to please the person that asked the question. So be very, very careful when you're putting stuff into AI. Will it get there? Will it be something that will be super helpful? I think so, but I think it's going to take some time. I don't think it's as fast as everyone believes it to be, especially in the context of international tax, cross-border tax. I think be very, very careful there. Okay, this is a table I got from Andrew Mitchell. He puts this out every year. It's the number of U.S. citizens that have expatriated, and this is not green card holders. On average, there's about 20 to 25,000 green card holders that give up their green card every year. But for U.S. citizens, you can see in 2025, 4,892 U.S. citizens gave up their citizenship. So exit tax is still going pretty strong. People are still giving up their citizenship and their green card. Um, there is a processing backlog with the IRS currently right now. So there was a shutdown, for those of you that don't remember, from October 1st to November 12th of last year. During the shutdown, 50% of the IRS was furloughed, meaning they were not working. And so if you mailed something into the IRS, maybe you mailed in a tax return that was due by 10/15, maybe you were a taxpayer living offshore and you had to mail in a tax return that was due by 12/15, or you did a request for residency certificate, or you applied for an I-10. You may not have gotten an answer on that yet, and it's not because it hasn't been processed. It's because they're maybe in the backlog. So, unlike the John Lennon song, there's no instant karma for you here. So you may want to be careful with concluding there are no issues, because there certainly could be. This is kind of where the IRS inventory was at the end of the backlog was at the end of 2025. It is now at 2 million and potentially rising because the IRS had to dedicate a lot of resources to putting together the 2025 tax return in a very short period of time. Normally, the IRS has about 10 to 12 weeks to do that. I think they had about 6 weeks to do that due to the shutdown. Um, I will note that if you look at the top here of the slide, this is IRS staffing. So in 2021, in October, the staffing level total was 81,492. The high water mark was October 2024. The IRS was up to 100,000 plus. They were clocking and moving, and things were getting done. And then due to the layoffs and the retirees, they're back down as of October 2025 to 81,456. I will bring your eyeball down to the bottom of the slide though, and the number of employees dedicated to the filing season is down to 39,315. That's a really low level, okay? Last year, the 47,000, so they had a lot more people to help out for filing season. This year, they're kind of limping along. So be real careful when interacting with the IRS. I'll talk more about ways to deal with the IRS here at the end, but just keep that in mind. Okay, this is the inflation adjustments that I think people need to be aware of for 2026. So not related to the 2025 tax return, but rather for tax planning for 2026. I will note that if you are trying to contact IRS appeals, there's an error in the published phone number for IRS appeals. I just want to make sure to put that out here. This is the correct phone number to use. So if you're trying to get in contact with an IRS appeals officer or the appeals unit, the phone number you want is highlighted here at the bottom. The IRS wanted to make sure everyone knew that. There's a new thing with the IRS for first-time penalty abatement. In the past, you had to physically ask for that, normally by calling the IRS or filing Form 843. Now, the IRS is going to have an algorithm, an AI algorithm, it's an internal AI algorithm, that is going to be looking at your filing history and your qualifications for first-time penalty abatement, and you will just automatically get this. So the IRS may send you a notice, so don't be, I know people get afraid whenever they get a notice from the IRS, whether it's good or bad news, but you may automatically get a notice for first-time penalty abatement from the IRS under this new procedure. So if you qualify for it, you may not even know you qualify for it. You may get that notice. So be aware that that could come through. I'm not going to go through this, but these are the qualifications for first-time penalty abatement in case you were wondering. You do not generally get first-time penalty abatement on an international tax form. So if you got a $10,000 penalty, normally that's not going to apply to the situation. I will just, for a little bit of a side note here, the IRS publishes what they call their no ruling list every single year, meaning these are things that they will not issue a private letter ruling on if you were to ask. I like to bring this up because I get this question all the time from G4s. Can I get the IRS to give me a letter saying I'm exempt from the substantial presence test? That's 7701. Can I get the IRS to tell me my wages with the World Bank are not taxable? That's 893. The answer to both those questions is no. The IRS will not write it, will not opine upon that. They will not answer that question. Interestingly enough, though, the IRS has also told us that for those folks down in Mexico that have a fideicomiso, they're not going to tell you if that's a foreign grantor trust or not. So too bad, so sad on that one. The IRS is not going to tell you if reasonable cause exists for failure to file an informational return. They're not going to tell you about qualified business units. So if you're foreign rental or if you're foreign self-employed, whether or not you're a qualified business unit. They're not going to tell you about trusts that have staking of digital assets. They're not going to tell you if you qualify for the qualified business income deduction or not. They're not going to tell you about FATCA, and they're not going to tell you about cross-border informational transfer between the US government and other foreign governments. And last but not least, they're not going to tell you whether an estate is a foreign estate or a domestic estate. You're just going to have to use the US tax practitioner to get your consulting advice for those items. There is a new procedure for retroactive QEF elections for PFIC. So if you got a PFIC and you didn't realize that you could have done a QEF election and you're a couple years late on it, you can do a retroactive QEF election. You can actually contact the IRS. There's an email here. There's this whole procedure, Revenue Procedure 2026-10. If they try to make it as easy for you as possible to let you know if you think you're a good candidate for relief, what the cost would be for the PLR, all that stuff. I will note, though, that I think it was brought to my attention that in order to qualify for this, you did have to be using a U.S. tax preparer to do the returns that you originally filed that you failed to do the election on. So make sure you look at the qualifications closely if that's something that you want to do. Okay, we're getting close to the end here, and then I'll answer some questions. So if you have questions, please put those in the Q&A. TIGTA is the part of the federal government that oversees the IRS. TIGTA has basically released the areas that they will be kind of following up with the IRS so the IRS does more enforcement. So the first area is going to be foreign corporations. So foreign corporations that have U.S. source income or non-effectively connected income, or maybe own U.S. limited liability companies or own U.S. real property. Apparently, they've noticed that there's been a delinquency in filing the Form 1120-F. So they're going to be looking to enforce that. There may be some audits that happen for folks that have foreign corporations that have ties to the U.S. They are looking heavily at FIRPTA, so Forms 8288, 8288A, B, and C. For those of you that didn't know, there is an 8288C form. It's normally for partnerships, but they are looking to heavily enforce FIRPTA and make sure that there is FIRPTA compliance. So I think you'll see a lot of movement on FIRPTA and FIRPTA audits in 2026, 2027. They want to see the IRS be better at giving residency certificates. That's that 6166 letter that you do through the 8802 form. They want to make sure that people residing outside the United States actually get better customer service when calling into the IRS. So increasing the capability of the international tax phone service. And then there's a study that was put out by TIGTA about the people that failed to get penalty relief for the COVID years, 2021 and 2020. Apparently, the IRS should have given failure to pay, failure to file penalty relief for certain people based on the changes to the deadlines that were due that never happened. According to the study, there's about 4.9 million individuals, businesses, trusts in the states that should have gotten about $1 billion of penalty relief, but didn't. So you may want to potentially go back and look at your 2020 and 2021 tax returns and kind of look to see if you got a penalty of some kind, failure to pay, failure to file, and maybe you were due relief, and maybe you should ask for it under Form 843. So definitely something to consider. Okay, moving on. I've seen a pretty significant uptick in people that have this issue. It's related to Internal Revenue Code 7345, and it's for people that have seriously delinquent tax debt. If you have seriously delinquent tax debt, which is defined as tax debt that for 2026, it exceeds $66,000, what can happen is that the IRS can send the State Department a certification indicating that you have seriously delinquent tax debt. And then what will happen is that you will get stopped at the airport when you try to travel. They will stop you and they will not allow you to travel until you have fixed that issue with the IRS. You've got into an installment agreement, an offer in compromise, or a promise to full pay or actually full pay the debt. Several clients that I've had living offshore have been has literally stopped trying to enter the United States, and we've had to kind of work out a deal to get this done. I've been asked a couple times, can this be challenged in tax court? Is there a way around it? Um, and I bring up the Spencer case here from earlier this year to basically indicate that the answer is no. Once you have the debt, it's hard to combat that in tax court. And in this case, there was a what we call a 12B6 motion, so a motion for summary judgment, which is really hard to get for any attorneys that are in the audience. You'll know what I'm talking about. Um, and the IRS submitted it with a copy of the account transcripts that showed that this person owed $1.6 million of tax debt to the IRS. And that was it. That was all the court needed to see. Motion in the light most favorable to the non-moving party, even with all that in favor of the taxpayer, didn't work out. Spencer was denied relief. So long story short, if you got seriously delinquent tax debt, fix that with the IRS before you travel. Okay. Innocent spouse relief. So, for example, you have a married couple that's filing. You have spouse one that has to file an informational report. They file it late. They get a $10,000 penalty. But since it's a married filing joint return, that $10,000 penalty applies to both spouses because you take on the liability jointly when you file jointly. So the question was put before the IRS Chief Counsel, can the spouse, the other spouse, spouse two, that has nothing to do with the informational return, take a position under what we call innocent spouse relief to get out of the $10,000 penalty? Spouse one would still have the penalty, but spouse two would not. And Chief Counsel said, absolutely not. No way, Jose. You can't use innocent spouse relief to get out of a $10,000 penalty for an informational form. You can still use reasonable cause, but you can't use innocent spouse relief. So sorry for any spouse that's having to absorb that liability for their other spouse. Here's kind of what the IRS said here, and I'm not going to go through that. Cross-border informational sharing. So I bring up two cases here. You have the Fancinelli case and you have the Jenkins case. So this one's out of Spain and this one's out of Italy. But basically, in these two cases, in this case in particular, the Alvarez case, the Spanish tax authorities wanted to know about the Spanish. This is a Spanish taxpayer that had U.S. bank accounts. They wanted to know about the U.S. bank accounts, and they made a summons, and the client contested that, or the taxpayer contested that, and the court said, nope, we're going to allow that to occur. So in this particular case, the United States government reported back to the Spanish tax authorities all of the U.S. bank accounts for Alvarez. Same thing here with Fancinelli. That was Italy. Same thing happened. They reported all the stuff back to Italy. So for those people, I get to ask this question all the time. How will they know about my U.S.-based items because the U.S. doesn't normally report back on FATCA? Well, if they actually make a request for it, the United States government is playing ball on some of these things, and it can, as these two cases show you, occur. So be very careful about making sure that you're reporting, if you're required to, your US-based assets in your foreign country. Okay, IRS criminal investigations. There is a lot of concern and worry about changes to Department of Justice and IRS criminal investigations. Last year, 2025, the amount of investigations into abusive tax schemes plummeted by 63%, which is massive. Okay. And this is a letter to the Treasury, Secretary of Treasury, that was detailing that. But there's a significant decline in IRS criminal investigations going after people that have committed tax crimes. And so basically everyone's trying to get to the bottom of why this is the case. But keep that in mind for that particular issue. Okay, and I think this is the last that I've got for you here. It's my personal pitch to everyone that's on this call. If you don't have an IRS online account, I strongly suggest that you go get one, go sign up for one. If you're married filing joint, both spouses need to get one. I think the way everything is moving with the IRS, everything's going to start going through the IRS online account. You need to have one. I get it's scary. You go in there, you check it. You may not like what you see, but I say rip it off like a Band-Aid and go check it and go look at it. Very, very, very important. I think that the functionality in the IRS online account, we're just scratching the surface as to the way that the IRS is going to be using this to interact with taxpayers. So again, I will strongly make the pitch here, go get your IRS online account. I will be providing updates throughout the calendar year through the podcast we have here at the Wolf Group, the Essential Tax Podcast, which is on Apple, Spotify, and YouTube. So go check me out there. And then this is contact information if you need to get a hold of me. We don't have a whole lot of questions, but I'll go through them. Um, First question for 2026, what are the taxable income boundaries for different tax brackets? I did not put that in the slides. I apologize for not doing so. I certainly can email you afterwards with that information. Okay, next question. The slides list Maryland under the states that are decoupling. I'd like to know what that means in practical terms. It's selective decoupling, and it's mainly for businesses. I think it was related to R&D credits and some of the stuff for business-related items. I think for the most part, Maryland has conformed to a lot of the big changes for enhanced senior deduction, tips over time, things like that. But it's not something that I think would affect a normal individual taxpayer. Okay. Remittance transfer tax legislation. So the question says, does the additional taxation also apply to transfers from one person's foreign account into their U.S. account, your own money? So the transfer tax is only from a U.S. account. And at this point, it's really only from, again, Western Union and those types of places. But under the proposals, it would have to come from a US based bank account inside the United States to an account outside the United States. And it would apply to anyone that's not a US citizen. Doesn't matter if it's your money to your money, has no bearing on that at all. It's only is the question is the transfer coming from inside the United States to outside the United States? Okay. So that's what the proposed legislation says. And that's what it originally said in the OB3 legislation until cooler heads prevailed and they carved out a bunch of exceptions. Okay. Um, Question, how can I find more details regarding the U.S.-France double tax agreement and how to use taxes paid in the U.S. reported to ensure not paying taxes twice? Well, the treaty, I'm not certain is going to be overly helpful for that. I think more so what you want to look at is the foreign tax credit provisions, which are the 900 section of the Internal Revenue Code. That's codified law. You get that regardless of whether there's a treaty or not. The tax treaty more so, I think, is helpful for resourcing income to get the foreign tax credit to apply. But generally speaking, I think the answer that you're talking about here is the foreign tax credit. And you can look up any tax treaty. You can go to irs.gov and you can look up any tax treaty, the technical memoranda that they have that explains the treaty, and then any updates that go along with the treaty as well. Okay, how is Virginia decoupling? I don't think Virginia is decoupling, but if they are, it'd be very selective. Virginia, for the most part, I've looked at the Virginia 760, and it conforms a lot. And I had a lot of questions the other day on the enhanced senior deduction. There's a big schedule that Virginia has on the 760 and a special place that now goes into that you have to determine to get that enhanced deduction there. But again, Virginia, like Maryland, I think DC is more so decoupling on the ones that would affect an individual taxpayer, whereas Virginia and Maryland, I think for the most part, will kind of follow along with the federal. I don't see any big issues there. Okay. All right. Yes, and I will send you the bracket boundaries to your email. I've got your email here. I'll make sure to get that to you here in a minute. Okay. I don't see any other questions. So with that, I thank you all for attending. Hopefully, I've given you some good actionable, things to think about and to use going forward. If there's any new tax legislation or new things that roll out during the calendar year, we'll make sure to have new webinars and podcasts, etc. And we'll get that information out to you. Thank you so much.